Hey guys, what is up? It's Arthur here, and in this video we're going to talk about Universal Health Services, ticker symbol UHS, as it was requested by one of you guys in a previous video's comment section. So if you have a company or stock in mind that you would like to have reviewed, leave a comment and we will make sure to take a look at it. 2024 data is out, at least on MarketWatch, so we can take a look at it. I don't know why, but sometimes MarketWatch lags behind. This data was available on other sources like Yahoo Finance, so I had to write MarketWatch an email asking why this is. I don't know if that was the reason, but now we have it, so we can take a look at it as my Google Sheets is using MarketWatch data. So what we can see on my dashboard is that it's green growth numbers at any time horizon that you look at, which is very nice to see, but we are smart cookies and we don't trust previous prices because past performance is not an indicator of future performance. And so by the end of this video, you will see that it is not all green, and I will help explain what each of the 10 checklist items on the side means and what you can do with them to do more research and get a better picture of this company. So what we can see is that the market cap is 12.75 billion. It's a decent sized company, but still small if you compare it to large companies that you know of. If you know Apple's market cap, what the whole company is worth, is 3.1 trillion. So if we want to compare UHS to Apple, 10% of Apple's value would be 310 million, 1% would be 31 million. So this is roughly 0.3% of the whole Apple. So that's the size of UHS compared to Apple. We can see that the enterprise value is a lot higher than market cap, which is going to tell us there is a lot of debt in this business because enterprise value is just market cap plus the debt minus the cash. So if you end up over market cap, you have debt. If you end up below, you have more cash. Unfortunately, we have more debt. So it is going to be interesting how they manage that and what's their plan on doing that, and also what they use that debt for, because not all debt is evil. If you make more money than it costs, that's good. Also, what else? Gross profit margin increasing over in the last 12 months compared to 5 years. That's good. That is also true for profit margins, so that is good. We're being more efficient in this company. And what this company, so like the areas that we are doing with, I kind of forgot to showcase you this company, but we are basically operating in this company acute care hospital services, behavioral healthcare services, and others. We have hospitals, freestanding emergency departments, ambulatory centers, and then we have care services offering treatments for depression, anxiety, psychotic diagnosis, bipolar disorder, and so on. So we are into healthcare stuff, and then we also have other segments to support all this, I guess: IT, purchasing, reimbursement, accounting and finance, taxation, legal, advertising, design and construction, and so on. So this is what we do, and it's nice to see that we are being more efficient at running all this. What else? We can see there is a dividend, $0.2, so 20 cents every time they issue it, 4 times a year, because the annual dividend is $0.8, which equates to a dividend yield of 0.4, which is very low. This translates to $53 million paid out, and you want to make sure that they can pay this. Now this is in the past 12 months, called TTM, trailing 12 months, and this is paid out from free cash flow, which is 1 billion, so they can easily afford it. Dividend has been growing nicely in the past 5 years, very, very nicely, but it would still take some time for it to be a meaningful dividend. What I used to look at was the payout ratio that tells you of the cash that they have, that they also use to pay dividends, how much of that is tied up in paying these dividends. And I upgraded this. This is called the augmented payout ratio. And I not invented this, I just use this, but I think it's a better way because it also includes giving back shares that we're going to talk about. So buying back shares, giving back value to investors. That way and it's only 5% in the trailing 12 months, meaning that they have a lot of cash that they can use for other things. Well, we'll get to that. This was 104% in the past 5 years on average. Not on average, but in the past 5 years, they paid out more than the cash that they had. So they didn't have money left over to do other things. And net acquisitions is not that high either. Because we're making $1 billion in the past 12 months. And we have only acquired companies in the value of like 250 million. Which growth-wise is like a coin with two sides. You're not really buying up the competition, but you manage to improve your ratios just by running your own company. And that's good to see, because we want to see growth through good management practices and good operational practices, and not just buying up companies and boost your numbers that way. So talking about numbers, let's see what we have. First up, we want to see if a revenue has been going up. I'm gonna go to Market Watch, which I like to use. They have a financials section that houses all the financial, not all, but the major financial statements that you're gonna look at are housed here, and it goes from left to right, which I think makes sense. Yahoo Finance goes from right to left. It's your preference. I like it this way better. So first up, we want to see if your revenue has been growing. We have been growing from 11.56 billion all the way up to 15.83. It is a very nice, smooth increase of 37%. This is very nice to see. So that's a check mark there. Next up, this is the top line. So everything you sell, this is sales or revenue. As you work your way down, literally line by line, deducting all the expenses that you incurred along the way, selling all those things, you're going to arrive at net income, how much you take home. And this has been all over the place, going from 940 million to 1.14 billion, which isn't that much of an increase as in terms of revenue. So you can take a look at the items and see where it slowed down, what happened there. You can try and dig deeper what happened and what was the cause of that. It is still up 21%, but we took a big dip. It is a check mark. It's growth. It's good to see. The average 5-year net income that you can see on the top right of the card, you just take all these numbers and you average them out. It's going to be around 900 million. And one metric that people like to look at is that you take the average of that, roughly 900 million, and you go back to your market cap, which was 12.75 billion. You can see it on the top card, but you can also very easily see that at any kind of financial website. So what you're going to do is you're going to take this and divide it by your 5-year net income. And so you will get the PE ratio, also called the price to earnings ratio, which is going to tell you that if you buy this company right now, how many years it will take for the company in net earnings to make up for the purchase price. And I'm talking about buying this company because you can either talk in terms of shares, then you have price to earnings. Price will be the price of one share and earnings will be earnings per share. But it's easier and I think more wiser to think about buying the whole company, because this is really what you're doing. You're buying a piece of the company. And so I just do market cap divided by their earnings, and just thinking about this is gonna give you 14.28, which is a check mark because you want it to be under 20. So it is not expensive. With PE ratios, something under 12 is considered cheap. Around 15 to 18, fairly valued. Above 20, expensive. These are just broad ranges. These are not set in stone. But one improvement that I made that I really like the idea of, and I want you guys to actually take the lesson home. That is, different industries have different PE ratios. So what I just told about these broad ranges, being undervalued, fairly valued, overvalued, does not apply to all industries. So what I do is that I take this number and compare it to the median PE ratio of the industry that they are in. How do you do that? I found a great way. You can go to TradingView and look up the individual company, and then above there you can see there is this section which is the breadcrumbs, and you go to the most direct category, hospital nursing management. It's going to list out sort of competitors or like other companies that work in the same field, and you also have a PE column. And what I do is I take this and find the median number. So if you line them up, I'm showing this to you from lowest to highest, you're going to take the middle one that is, I think, most representative of this scenario. And so you would get that the PE ratio of UHS is actually higher than the median value of competitors. So that's an X, because it is more, even though you would think it is roughly fairly valued, it is still more expensive than similar companies that you can also take a look at. So that's an X there. And so the next metric that I want to look at is, okay, if I buy this company and I put money into this company, how well they run this company, how much money they can generate with every dollar that we put into this company. And that is a wonderful metric to tell you that. It is called return on invested capital. Now the market average is roughly 9 to 10%, so I'm just looking for above 10% to be nice and round and memorable. And this is not, before I show you the value, I want to tell you this is not a generally accepted metric. So different websites might calculate it differently. If you want to see how I calculated it, we can take a look at it. I calculated it to be 8.66%, so roughly in line with market average, slightly below that. So that's an X. You can also go on the Market Watch, the profile, and they're going to have it here on return on invested capital. Here it's 12.01%. Again, this is not a set in stone metric that everyone shares the same methodology on how to calculate it. We can take a look at it if you want, leave a comment and we'll cover that. But for now, this is an X here. We're going to go to financials for the next metric, which I absolutely love. And I think this is really nice to see for UHS. We're going to see the ownership structure evolution through the number of shares that are out in the market, because there's one cool thing that companies can do is that they buy back shares. So essentially they reduce the potential supply of shares. And so you might know supply and demand, if there is less of something, it's more valuable. So what companies do with this, they buy back shares and make one share more expensive that way. So if you're already an owner, your shares will be worth more. And that's how they're gonna make sort of unrealized gains for you. You can find that in the income statement. We worked our way. This is how much you take home. Now you gotta talk about how many ways you have to divide that. Basically, shareholders. There is basic shares outstanding. I take diluted shares outstanding. Difference being this also includes like convertible options and employee stock options. So it's just the potential maximum that you can see. And we can see that we are down from 85 million to 68 million roughly. So that means we are down almost 21%, which is phenomenal to see. Down 21% in 5 years is massive. Other companies do like 5%, like 5%. I'm like, okay, that's nice. 10% is really nice to see. 21 is amazing to see. And I would dive deep into it and see, not dive deep into it, but dive deeper to see if they have communicated further plans to buy back more shares. Because what buying, like, there's two things you can do with shares. You can either buy back, as I explained, or you can issue more. When companies issue more, there are new buyers who buy that newly issued round of shares, and that's how the company raises money. But they also dilute owners in the process. So if you were an owner and the company issues more shares, you're just going to become a smaller owner because there are new owners coming into the mix, which is not good. We hate that number. We hate this number going up. That is terrible. But if it's going down, that means the company is also looking for good deals. So what this might show you is that they also think that stock, their own stock, is currently cheap. So this might be a good sign. You shouldn't rely on just this, but this might be a good sign that they also think that there is good value in the current price, and they are loving to buy back shares. You're gonna dig deeper and understand why this is, but this is a really good sign, because if a company is issuing shares, it's usually on the expensive side because they can raise more money for one share, and so basically fools buy that so the company can raise more money. But if they are buying back their own, that's always nice to see, and it just confirms that they see some value in this, and they think that is a good use of their cash. Okay, enough rambling. Let's move on. That is a huge check mark here. And so the next one I want to take a look at is their sort of balance sheet structure. One quick metric is that we're going to take at their 5-year long-term liabilities, the rate at which that has been growing, and we're going to compare it to the 5-year revenue growth that we have seen in the first card and the first item. So long-term liabilities means all the debt that they have to pay that is due in more than 1 year. What's due within 1 year would be current liabilities. That's the distinction. Whether it is within 1 year, it's current liability. If it's more than 1 year, it's long-term liabilities. Now the trick is there is no summary line for long-term liabilities. So what you can do is take total liabilities and then deduct total current liabilities, so you get total long-term liabilities. And then you can see how much it has grown from this year to this year, or decreased. And then you're going to compare it to your 5-year revenue increase. And if you do that, you will see that 28% increase in long-term liabilities is a lot less than 37% revenue increase that you managed to do in the first item. And this is a check mark. And what this tells you is that they took on some debt, but they managed to grow revenues and sales faster than the amount of debt or the ratio of debt that they took on, which is a huge check mark. It's roughly like how much, like 1.25x, something like that. So yeah, it's like a 25% faster increase that they could get on revenues, which is nice. And now, one of my favorite metrics is that we want to take a look at their free cash flow. Free cash flow is the money that's left over at the company at the end of the day. It's basically money coming in minus money going out. It's hard, cold cash, and it's harder to manipulate than net income. A lot of people think they are very similar, might be even the same thing, but they are not. Free cash flow is harder to manipulate. Net income is a bit easier. So you also want to take a look at the ratio. So like if you take a look at free cash flow, let's say the average here, trailing 12 months, and then net income, you want this to be very close by. You don't want net income to be a lot higher, because that can indicate some kind of fraud. You would want this to be somewhat close to each other, net income and free cash flow for the same time period. Just make sure that they are either the very same, roughly the same, or just like, within reasonable distance. Anyhow, calculating free cash flow, very easy. you're just gonna take net operating cash flow and add this minus number. Plus minus number is actually gonna be a minus. So basically just, in most cases, you can end up a smaller number than net operating cash flow. So net operating cash flow plus the minus capital expenditure, and you're gonna get your free cash flow for a given year. You do that for all 5 years, and then you take the average. So you get your free cash flow average, but MarketWatch also lists it here. You wanna see, we are looking for the increase here, and then we're gonna use also the average. If you do that, you can see that we are actually down from 1.6 billion to 1.12 billion. And this is a massive cliff that they just dropped off. And I'll let you know, this is 2020, which was a very profitable year for any kind of health service, if you know about the pandemic. So this poses very interesting questions, because when you go investing, you have to make your own assumptions and whether you can take certain numbers into account. Now, this is a year I would not take into account personally, because I think this is not something that would happen every year, like every 10 year, whatever. This is not indicative of their regular performance. And looking at this, they barely made any money the following year. You can look at what happened in the above lines and try to figure out where all that money went, but they might have had to increase capacity to cater to the sudden increase in demand, and then in 2021 maybe that demand really fall off and they struggle to run all the increased capacity. I don't know, I'm just hypothesizing here, but this is a huge drop and it makes it really hard to see what the average growth pattern will be here that I will use for to put a value on this company or the share price, instead of just looking at this and thinking this is a good price or not a good price, because you see it's $198. How do you know if it's good or bad? Is it too expensive? Is it too cheap? I'll show you a way I put a price on this company that maybe you can use, or ask in a comment to have me explain it so you know what you're doing, because I'm a big fan of understanding what you do, not just following whatever you see on the internet. All right, so then you have free cash flow, you have the average of that, again just average the 5 numbers, you have 700 million on average that you can say the company likely makes every year. What you can do with this number is that, remember we calculated long-term liabilities? You have that number if you did total long-term liability, no, total liabilities, like the full thing, total liabilities minus total current liabilities, so you have total long-term liabilities. And what you can do with that is you can you can divide that by this average free cash flow that you have, and that's going to give you 8.25. Now what does that mean? That's a huge X, because I want this number to be below 5. What this means is that with the average free cash flow that you have as a company in a given year, it would take you 8.25 years to pay off all your debt. Now that's a long time, considering that you can use free cash flow for 5 different things. Okay, and these 5 things are gonna fight for a piece of that free cash flow. You can reinvest in the business, which you would likely want to do if you want to grow this business. You can buy other companies, which they have done some, but they seemingly grow out of their own wit. And you can also issue a dividend, which they do, but seems like they cut back on it. You can also buy back shares, which they do to a great extent. And you can, what's the fifth that you can do? You can pay down your debt, as we were just discussing. So it would take you 8.25 years if you didn't do any of the other 4 things. So that's a very tough situation, and goes back to me saying based on the enterprise value that we have a lot of debt in this business. And you would be interested in why that is. Did they take on debt to build new hospitals, some new factory that is sort of a one-time cost, and you're looking into the future expecting money to be coming from that? Or what does that serves for? What's the purpose of that? And what's their plan on paying that down? What's the expected return on that? You would have to understand, because that's a lot of debt. You are in a sort of brick and mortar business. You have hospitals, you have emergency rooms and whatnot. So those companies tend to have more debt. They are also in an easier spot to get debt because you have collateral. You can offer these hospitals and buildings as collateral. So if you default on the loan or debt, you can just give a hospital in exchange or whatever. And that companies that are more physical in nature tend to have more debt. Because of that, it's easier to get debt as compared to like a Google or something, like a startup software company that has sort of nothing to offer. If they default on a debt, maybe their software that didn't succeed, so like 5 computers, so that's not really that much of a collateral that they can put out. And also, as a final measure, you can also do what you did with price to earnings, sort of getting a number for how many years it would take to recoup your investment in this business. You're going to take the average free cash flow of roughly 700 million, and you're going to again take the price, the market cap of this company, 12.75 billion, as you can also see on the overview. You're going to take this number and divide it by your average free cash flow, which is going to give you a number of 17.88 years, which is below 20. That's good. So it would take, if you buy this whole company, you pay $12.75 billion for this company. The whole thing is yours. You're 100% the owner of Universal Health Services. It would take you 17.88 years with the current 5-year average free cash flow to make back your money in free cash flow, so you can grow your business that way, which is okay. That's a check mark. So UHS, Universal Health Services, ends up with 6 out of 10, which is respectable. As we mentioned, there is a lot of debt in this business that they sort of have to sort out, or you would have to at least have to understand what's the plan with it. They seem to be using that well because revenues have been growing faster than the debt that they are taking on. But the free cash flow section is all over the place, and it is growing, but you're still not up to your 2020 peak. So that is sort of problematic to see and harder to calculate with. The last thing I want to show you is a DCF, which is a discounted cash flow. Not here, sorry, I have 2 windows opened. We're gonna go here. It's gonna be this. Let's get back our checklist. And then we're gonna go here and actually open DCF here. All right. And so what DCF stands for is discounted cash flow. What is, we know what cash flow is. It's the amount of cash that you get in a year, coming in, going out. This is the net, what you're left with. And then you're gonna project that into the future, okay? And then what's discounted means is that right now it's 2025. If I project what this company will make in this case 2025, because we only have data for 2024 as a closed financial year, you would have to, the example makes more sense. So let's say you're gonna project it until like 2026. Now, $1, like $100 in 2026 is not the same as $100 now. Similarly to how $100 today is not the same as $100 10 years ago. Okay, so this is the discount that, this is the idea of the discount, that you have to bring future values into today's perspective so you understand it. All right. And so the thing is, when I mentioned this huge cliff, off of 2020 free cash flow figures is that it makes really hard to estimate what's the growth rate. So do you consider this number? I wouldn't, but do you consider this? But because then in this 5-year span, you are actually down 9% every year roughly. But if you ignore that, you are like growing 240% every year. You're 3xing on average every year, although it is very easy to grow almost zero to big numbers and produce very high growth numbers. As you can see, this is almost a 10x. This is just a 2x. This is again just 2x, but it averages out to like 3.5x. So what's the plan here? What I did is you can look at more data. You can look at more data. Most of these financial websites for free offer just 5 years of data, but with a little bit going the puzzle way, you can go, for example, to macro trends and look at universal health services free cash flow, and that gives you 15 years. So you can take this. I took this table, this table on the left, and then I have it here. And you can do other calculations. So if you take a look at the whole thing, 15 years, the average is 13.8%. But do you, again, questions, your assumptions in investing, do you want to consider their values, 15 years ago? Is that relevant in today's, like, management might have changed, CEOs might have changed, other officers might have changed in the business, managers, the company might have been acquired, a lot might have changed. So is this even relevant? Again, your assumptions. You can take a more representative period. So take, for example, this is from 2013 to 2019. We went from 525 to 804. This is sort of still a somewhat rocky trajectory, but we managed to grow 7.3% every year on average. Or you can take more recently, because I think this is not a relevant year or something that is not very reproducible. Let's take a look at from 2019 to 2024, which is 6 years. And we went from 804 to 1.1 billion, which is on average 6.91%. And this might be something that I would use because I think this is more closer to reality. If you look at these numbers, somewhere the average free cash flow is around 650, 700 that they can produce with some better years, but for the most part it's around 700. So I'm just gonna change up these, and I would say that my growth rate is 691 to be exact, that I just calculated. I'm gonna project 10 years into the future. For the first 5 years, I'm gonna use that. In the second 5 years, I'm gonna halve that. We're gonna use the discount rate. That is again a different measure. Weighted average cost of capital, how expensive it is to raise different kinds of money. We can also talk about that if you leave a comment or if you're interested in that. But basic idea is that. Also, one additional thing. What is the base value that we want to increment into the future? You can use the average. We can use the latest financial data, 1.12 billion. We can use the trailing 12 month, which is very similar, or we can use the average. I'm more confident using the average, which is more conservative because I don't know how much of this is, it's very up and down. We're sort of off cliffs and then rocket growing. So I'm just leaning more conservative here. Also, my estimations are also more conservative, halving the growth in the second 5 years. But as you can see, we start from 713, for 2025, 762, 815, and so on. and then you can see it is converted to today's value. You're gonna sum up that, and you're gonna sum up all this, and you're gonna get a value for how much this company is worth. You're gonna add the cash and short-term investments and deduct the debt, because I think any company can have that, and you do get equity value. You think this is what the company is worth, and you're gonna calculate it for a share. So this is the company value. You're gonna take all the shares that are out here, and you're gonna get that the intrinsic value of a share, I think, is $122 compared to their current $197. So I think it is a $75 difference that is in this stock. I think it is overvalued at this stage, but again, we made a lot of assumptions along the way, and you have to make your own. If you change things up, let's say we're gonna use a, let's say you think this is very nice and this is the growth trajectory that they're gonna have, you can say it is 13.8% that they're gonna grow with, and this is more reasonable. So then now it's very undervalued. The stock should be worth twice as much as it is currently worth. So you can see how much it comes into play what assumptions you make. I rather be more conservative and miss out on dodgy deals. I'm not saying this is one, but I would rather miss out on some very, fine line deals and just only catch a very few very nice deals. So this is my analysis on Universal Health Services, UHS. I hope it was worth your time. Let me know what you think. I'm not familiar with this company. This is just an overview of the numbers. You would have to look more into it to better understand the business before you make a purchase. But if you have information about UHS, drop them in the comments. Let's talk about this and let me know what company we should look at next. Thank you for the time. I hope you enjoyed, and I hope to see you in another video. Thanks. Bye.